Monetary Policy Committee has decided to increase the repo rate by 25 basis points. That's to 7.25%. It takes the prime lending rate, which is what commercial banks charge consumers, to 10.75%. Governor Lesotho Kganyago has revised down growth in part due to load shedding.
Against this background, the MPC decided to increase the repurchase rate by 25 basis points to 7.25% per annum with effect from the 27th of January 2023. 3 members of the committee preferred the announced increase. 2 members preferred a 50 basis points increase.
Investment specialist at General Capital, Dr. Adrian Saville, joins us now to talk about the repo rate announcement. Very good evening to you, Doctor. Thank you so much for your time. So 25 basis points it is. What will it mean for the ordinary South African?
It comes at a time when South African households, the consumer, is under strain as a result of a number of years of very weak economic growth, recent bout of elevated inflation, and the established entrenched unemployment in the economy. So the economy from a household and a consumer perspective is already fragile, and the Reserve Bank is bringing the interest rates hike in an attempt to kill off inflation, which has already peaked and has been in the process of declining. So one could well argue that to some extent this rate hike is after the horse has bolted, and is unlikely to have the imagined effects of inflation on inflation. But certainly what it continues to evidence and demonstrate is the South African Reserve Bank's absolute commitment to monetary discipline, and that is a standout feature. So, whilst it comes with a dose of pain for already beleaguered consumers, it should be read against a backdrop of the importance of maintaining policy stability and policy integrity.
You said it comes after the fact. Was it absolutely necessary?
Yeah, that's a great question. I think if we were going to be, grumpier or more cynical about it, there was a better than even chance that the policy committee raised rates by 50 basis points, by 0.5%. So if anything, this came in, with a small dose or a smaller dose than what the market had expected. Consensus was that the rate would be hiked by 0.5%. I wasn't part of that consensus. My suspicion was that they would be more conservative or cautious, and they've been more conservative and cautious, I think, against the backdrop of the very fragile economy. Not that this interest rate move is likely to change economic growth or employment or household consumption for that matter. These are not particularly sensitive to interest rates, but it just, it is a tiny bit more pain. But could they have done zero? I don't think so. We've already seen the rand sell off in response to the 0.25% increase as opposed to the 0.5%.
Mm-hmm.
So the rand moved sharply weaker. And in and of itself, that's actually going to feed inflation with a little bit of a lag. So there's a second round effect here, which perhaps goes beyond this immediate conversation. I don't think that they could have done zero, no.
Is this still the post-COVID lockdown hike cycle, or is this now a completely different scenario, especially when you consider the global factors such as the Russian invasion of Ukraine, subsequent sanctions on Russia, gas shortages, and the rest of it?
I think this is post-COVID. So immediately post-COVID, it was necessary that the Reserve Bank normalized interest rates, because in order to provide COVID relief, interest rates had been cut very aggressively, and many people will recall the relief that interest rate cutting, that aggressive interest rate cutting had afforded. So as we came out of COVID, it was necessarily to normalize rates and get them back up to where they should be. With that done, we were then struck by a couple of inflationary factors, amongst them including the rand weakness, where a weak rand feeds inflation, the oil price shock that was caused by Russia-Ukraine, as you point out, and then the supply chain blockages and chokes that have had inflationary effects. And when we put those components into the inflation cocktail, it became evident that more was needed in order to quell inflation. And that's the terrain that we're in now. We're in the more is needed. All of this said, I think we're very close to the top of the cycle.
Does that mean then that the next announcement could be, in fact, a cut in interest rates?
Yeah, but you want the economic bad news. And the bad news is I think that cut, when it comes, as things stand, is a 2024 event. It's certainly not a 2023 event. So I think if rates are at the top, I would put a 50-50 probability that we have now found the top of the current interest rate cycle. And if we're not at the top, then I would say maybe another 0.25% increase in March. And then we're at the top.
So I shouldn't buy that sports car just yet.
Hang on to your horses for now.
And I was looking, Dr. Saville, as I was listening to you speak, News 24 here, they've done basically given us an example of what this means, where they say that on a new home loan of about 2 million rand at the prime rate, the latest increase hikes will now take the installment up by 340 rand, right? It sounds like a negligible amount, but they then say that since November of 2021, monthly repayments on a 2 million rand home loan have basically risen by 4,800 rand. And that proves, doesn't it, the danger of a prolonged hike cycle.
And I think that really hits it on the head, is that the 0.25% isn't the straw that breaks the camel's back. It's the cumulative effects from 2021 that start to compound, and that starts to weigh very heavily on the consumer. In the same breath, remember that the point of this monetary policy discipline is to get inflation out of the system. And if you don't have monetary policy discipline, then we could instead be staring down a barrel of 10 and 15% inflation per year, where the cost of living then won't be affected by the cost of servicing your debt, but instead will just be impacted by the cost of your shopping basket, the cost of your consumer basket. So you want to go and finance the car price has gone up by 10 or 15% per annum.
Just on inflation, Governor Kganyago today also flagged load shedding as something that is fueling inflation concerns in South Africa at the moment. When you listen to the statements from government at the moment, the idea is that load shedding will, quote unquote, stabilize, or things will get better within 12 to 18 months. How much is that of a threat to the inflation picture and what the SARB can do about interest rates?
I'm not sure that the SARB can do very much in terms of interest rates to affect the energy deficit and the impacts that energy is having on the economy. I think in this regard, interest rates would be a very, very blunt instrument. What's really needed here is for regulators, policymakers, and those responsible for the investment architecture, the infrastructure architecture of the South African economy, to get into the business of fixing the energy deficit. And you gave the throwaway about you shouldn't go and finance your sports car just yet. Now I can give my personal anecdote that I just received my residential statement. And what's being added to my residential statement, I'm in the very fortunate position of living in a building that has a generator. But that generator used to be tucked away as a nice-to-have component. It's now been added as a monthly installment to my cost of living. And it's a material number. Mm-hmm. So this is going to be inflationary. And that's just on at the margin and anecdotal. I think far more entrenched is the fact that we've got a close to 20% electricity increase on its way. And then, that is before you add in the cost of installing alternative energy, running your generator, and the impacts, the implications for smaller businesses in particular, I think these are materially worrying factors.
And what really sucks for most of us about the interest rate hikes is that they kick in almost immediately in most cases, isn't it? And in a country like South Africa, where even research shows that majority of us are living hand to mouth, that increases the risk to the broader economic picture.
Well, the interest rate does impact immediately. So no sooner has the South African Reserve Bank announced their interest rate hike, you will receive a note from your bank almost immediately advising you that your cost of borrowing has moved. Now, when interest rates are rising, that's painful. When interest rates are falling, that's wonderfully delightful that you get this immediate relief. But right now, we're still in the hiking part of the cycle. So you're absolutely right. That pain is felt almost immediately. The challenge is that when monetary policy is applied through hiking interest rates, it takes some time for the effects to be felt on inflation. So you feel the pain immediately. The benefit comes with the lag of 3, 6, 9 months. So prices and inflation take some time to respond to interest rate hikes. So we've got to take the medicine before we feel the benefits. Those benefits are lagged by months.
Never been a fan of medicine, but let's leave it there, Dr. Adrian Saville. Good to speak to you, investment specialist with General Capital.